Is $3,000 a big number if what gold does is maintain purchasing power and the purchasing power of the US dollar declines by 75%? The simple arithmetic says that the gold price should go up threefold or fourfold. By the end of the decade of the 70s, the prime rate of interest has gone from 4.5% to 18%. So your bonds, if they're long bonds, have lost 75% of their purchasing power. Your equity portfolio came into the decade of the 70s at the same price it exited. The gold price was up 30-fold in the course of the decade. We're going to have a dishonest default. We're going to say to this old geezer named Rick Ruo, you get $4,000 a month or whatever you get for Social Security. You're going to keep getting it, but we're going to devalue the purchasing power of the US dollar, just like we did in the decade of the 1970s. Past is prologue.
Hi, everyone. I'm Maggie Lake, and today I'm talking macro with Rick Rule, President and CEO of Rule Investment Media. Hi, Rick. How are you?
Hi, Maggie. I'm fine. The better for being back on with you. Thank you for having me back.
Well, thank you. I have been thinking about you because it is, I want to say, more than a year. It has been a while ago that we spoke, and you were talking about being concerned that so many people were underexposed to gold, didn't have any allocation to gold in their portfolio, and said if you just incrementally change that, you're going to see a big response, a big market response. And fast forward to today, and the gold market, of course, has been the focus of so much attention. Let's just kick off by getting a sense of how you feel about it now. How do you feel about the price action we've seen and where the market is now?
Well, it's interesting. On the face of it, looking at the arithmetic, investors are still uninterested in gold. Net flows, retail flows into gold, at least measured by the gold-oriented ETFs, have been mostly negative for the last year. Most of the buyers have been foreign central banks. At the time we talked, Maggie, you may not remember the arithmetic. You may. Many of your listeners won't be familiar with it, so we'll go over it. At the time we talked, I said that according to JP Morgan Chase, less than 0.5% of total savings and investment assets in the United States were oriented towards precious metals and precious metal securities. This is in contrast with a 4-decade mean of 2%. So there was no suggestion on my part that, the old gold bug stuff where gold had to replace U.S. treasuries or the U.S. dollar went the way of the dodo. All I was suggesting is that gold had to return to mean. And if gold returned to mean, we would have a 4-fold increase in demand. God only knows what happens to supply. And I talked about the arithmetic of why that happened or might happen. The arithmetic around why that may happen, which is to say systemic inflation, debt and deficits, has occurred. But the gold price move really hasn't been that dramatic in the historic context. And in direct answer to your question, Maggie, I don't see broader retail participation now than I saw then. I do see people who were smart enough to be attracted to the gold narrative being relieved that after all these years of waiting, they might be regarded as being right. 2 more points, if I may. When people asked me a year ago when the gold price might move, I would say to them, well, I think it's going to move in the year 2000. In the year 2000, the gold price was $250. It moved up to $2,500, which is to say a 10-fold increase in 24 years. Gold has increased since the year 2000 at almost 9% compounded, better than almost any other asset class. And yet people say, when is gold going to move? I think it's important that people understand that. If you want to go deeper into the arithmetic of gold, we can certainly do it. What I found in many broadcasts like this is that gold future is all about arithmetic. And most people prefer narrative to arithmetic. We'll go as deep as you want to go.
Well, I think that's a really important point you just made, because it has been, especially now, and I'll just lay the narrative on that's been the popular one, is why would I invest in gold, which seems boring, when I can invest in AI stocks, which were on the cusp of a revolution? It seems so whatever brings you to that, whether you are a technology leaning person and think that you're investing into the future, whether you're a momentum trader and are attracted by the massive gains that we saw in some of these stocks, those have been the narratives that are super popular. So how do you think about, and I know that your deep background is in commodities, but are you ever tempted by those narratives, and how do you figure out asset allocation when you've got that shiny, sexy narrative?
Those are great questions. Remember that I asked people to have the amount of gold in their portfolio that corresponds with the 4-decade median allocation, which is to say 2%. Most people have none. I'm not suggesting that people who understand technology don't invest in technology. I was born in Silicon Valley. I was born in San Jose, California. I watched the Fairchilds and the Intels and the Apples and all that stuff. I don't invest in them because I can't spell or pronounce them. I like to invest in things that I have a deep personal knowledge of and where I feel that my knowledge is competitive with the rest of the market. I require artificial intelligence because with regards to technology, I don't have much native intelligence. And so I prefer to constrict myself personally to things I understand. For those people who are more facile with technology, or more commonly today, those people who don't care what they don't know and they like momentum, absolutely play the technology game. But play the gold game too. Gold is simply a form of savings. And gold traditionally has done well when people begin to distrust the maintenance of their purchasing power in fiat-denominated savings instruments. Whether or not you happen to be a tech aficionado, when you look at $36 trillion in on-balance sheet obligations at the federal government level, and then $100 trillion in net present value and off-budget sheet allocations, irrespective of how you feel about artificial intelligence or data centers or things like that, you'd have to be a moron not to be concerned about the maintenance of your purchasing power in traditional savings instruments. So there's room for both, lots of room for both.
Mm.
I happen to speculate in areas that I know well. I know exploration well. I'm very competitive in exploration. So for me personally, I would rather take a risk on a drill hole play in a supposedly risky country like Congo than invest in some technology where I don't understand the market and I don't understand the technology. It doesn't mean that a person with an engineering degree wouldn't be much better placed taking a speculative bet in technology as opposed to a drill hole play, because it goes to their own range of competence, their own range of knowledge. Sadly, after 40 fairly benign investing years, the period 1982 to 2022, the prevailing thesis with regards to asset allocation has got a hunch, bet a bunch. And that usually doesn't work.
I love that. It's so true. It does feel like, we're kind of in that era, partly because passive investing has driven a lot of active managers out of the market, right? I mean, they've underperformed. And so that sort of level of expertise that you would look for has kind of gone by the wayside. So let's dig into yours a little bit. So we've got gold waking up, is maybe a way to put it, because you don't feel like you've even
Describes
seen
it
sort of
perfectly.
participation.
Describes it perfectly.
Yeah.
Yep.
So it's waking up. What are you looking for from here? Are you sort of not so focused on the price? Because let's face it, we're kind of in an environment where price targets drive a lot of also people's decision making. And if it hits a record high, then they think about jumping on. Are you focused on price, or are you more focused on demand, supply? What part of the market are you watching?
I'm focused on, sorry to be boring, math. I look at the U.S. economy, which is still the strongest economy in the developed world, and I look at inherent structural flaws. According to the Internal Revenue Service, the net private wealth in the United States is $141 trillion. Your audience should write that number down, $141 trillion. That's what we're worth outside of our government. The net on-balance sheet liabilities are $30 trillion. The net off-balance sheet liabilities are $100 trillion. Those numbers on balance sheet deficit increases by $2 trillion a year, and off balance sheet by another $2 trillion a year. In 3 years following current trends, the net federal obligations on balance sheet and off balance sheet will exceed the net private wealth of American citizens. This is simple arithmetic. This isn't some cranky old libertarian called Rick Rule. This is the Congressional Budget Office and the IRS that are giving you these numbers, okay? They're the enemy's numbers, not mine. Now, we faced this before. How do we get out of this? Well, we could have an honest default. We could say to the bondholders, yeah, we entered into a contract to pay you back, but we're not gonna, and we have a big Navy. And we could say to the entitlement beneficiaries, the Social Security guys, yes, we realize you paid into it for 60 years. I've paid into it for 60 years. Yeah, you paid in. You deserve it. Too bad. So sad. No money. Strong letter to follow. That would be an honest default, right? We don't have the money, so you're not going to get paid. That's difficult for politicians because old folks vote. So what are we going to do about this, Maggie? We're going to have a dishonest default. We're going to say to this old geezer named Rick Rule, you get $4,000 a month or whatever you get for Social Security. You're going to keep getting it. But we're going to devalue the purchasing power of the U.S. dollar, just like we did in the decade of the 1970s. Past is prologue. According to the Office of Management and Budget, in the period 1970 to 1980, the purchasing power of the U.S. dollar declined by 75%. So this old geezer is still going to get $4,000 in Social Security. That's going to buy $1,000 worth of goods and services, but your taxes won't be indexed to inflation. That's how we get out of it. And by the way, Maggie, in the period 1970 to 1980, when the purchasing power of the U.S. dollar declined by 75%, the gold price ran 30-fold. Is it going to run 30-fold again? Of course not, because it starts from a much higher base. But is $3,000 a big number if what gold does is maintain purchasing power and the purchasing power of the U.S. dollar declines by 75%? The simple arithmetic says that the gold price should go up threefold or fourfold with regards to that. Will that happen? I don't know. But I don't know any other politically feasible way that we can deal with an insolvent federal government. We have a liquid federal government. The federal government has cash right now, but we don't have a solvent federal government. Liquidity and solvency are very different issues. And if we resolve the conflict between liquidity and solvency, history teaches us that gold will do well.
Yeah, it is the ugly truth that no one wants to face. But we're having conversations around the edge of it all the time when we talk about these deficit numbers. The Trump administration's made it pretty clear they want a lower dollar.
No, they don't.
Lower
dollar. Lower dollar. Yes, they do. But they don't actually want to cut the budget.
No.
They want to punish their enemies and reward their friends. Naked commercial for myself. I have an upcoming investment conference in Boca Raton, Florida. And my keynote political speaker is David Stockman. David was the director of the Office of Management and Budget in the Reagan years. You might not be old enough, but I'm certainly old enough to remember that Reagan had a real mandate to reduce the size of government. David Stockman was the guy in charge of doing that. He wrote a wonderful book called The Triumph of Politics that describes how the Reagan Revolution was derailed by Republicans and Democrats in Congress within 6 months of the inauguration of Reagan. David Stockman has published a subsequent book, sort of an open letter to the Department of Government Efficiency, saying how to cut $2 trillion from the federal budget. The probability of those cuts being enacted politically is nil.
Yeah, he needs the subtitle, "And keep your job." Which,
yeah, I mean, people believe that taxes that are charged to other people are reasonable and necessary, that regulations imposed on other people are necessary, but they don't want to eat that same cake that they bake for others. It's interesting that at the same time that the Department of Government Efficiency, and by the way, maybe I am a never Trumper. I'm just a never all those guys. At the same time that they allegedly have found $1 trillion worth of fraud, nobody's been charged. Nobody's been charged.
Yeah.
Where's the prosecution? Where's the fraud? At the same time that they claim to have cut hundreds of billions of dollars from the budget, they passed a congressional continuing resolution increasing the debt ceiling and running one of the largest quarterly deficits in history. I know this is going to get us a lot of hate, Maggie. And I know that there are people that are attracted to the Trump narrative. I'm an old lender. My world runs on arithmetic.
I was just going to say, this is a conversation about math. Yep. Last time I checked, not politics, math. Yep. And you're pointing out the math that doesn't make sense to you, which I think is an important conversation to have right now.
I think that your listeners need to remember a poem that I was taught as a young man. It goes like this. See, I'm doing a little narrative for you. When your outgo exceeds your income, your upkeep becomes your downfall. If voters would send that on a postcard to Congress, when your outgo exceeds your income, your upkeep becomes your downfall. It really is just that simple.
Yeah. Well,
but
it's more of a cultural issue as well, right? We don't put anyone in office who would do that, or we don't acknowledge the truth ourselves. So there's a lot to go around. There's a lot of blame to go around.
Certainly there's old codgers who send me emails every day saying you're anti-Social Security. I say, no, I'm pro-math. I understand that you paid in every year. I, Rick Rule, have paid in for 60 years. They took the money, which we paid in, and they invested in low-yielding 30-year government IOUs, which didn't keep pace with inflation. And then they used the money to fund current deficits. People need to understand that while the obligations remain, the money is gone. Too bad, so sad. Gone. Whether or not you feel you deserve it.
So you mentioned that so we've got a very tough math situation that I think there was a lot of confidence when Scott Bessent came into office, because at least he maybe understands the math problem. Not to say that there's any easy solution to that. Let me ask you about something that was floated, because it's sort of related to the gold. There was talk about revaluing the gold, marking it to market today. There's talk of tokenizing the gold that we may or may not hold. Do you see something happening in that area? Because they're clearly going to try to be creative and get themselves out of this.
I absolutely do. And I think it's fraud. You revalue the gold from $40 to $3,000 as an example. The asset side of the federal government's balance sheet increases. But unless they use that gold specifically to secure debt, you can't monetize it. The problem isn't the asset side of the federal government. We have all kinds of assets. Nobody wants to sell the national parks. Nobody wants to sell the airspace. That's why I talk about the private net worth of Americans rather than the public net worth of Americans. Remember that I, as a bondholder, if they miss a payment, if I pitch up to Washington and present a bill to Mr. Trump, I have to remember that he has an Air Force and a Navy. He has a monopoly on force, violence, and extortion. Revaluing the gold does nothing to solve the deficit problem. It's an expenditure problem. We have lots and lots and lots of assets. But unless we change the way we organize society, we can't monetize those assets. So it doesn't.
On paper, things change, but in practicality, unless you're going to sell it off somewhere, nothing changes.
Where does
this idea of tokenizing these assets? Creating a.
I absolutely think they should tokenize them, but then what?
Well, I suppose, you kind of eventually get to the same.
I mean, if you're going to spend them, then the right thing to do is sell the gold off the way Canada and Great Britain did. A stupid thing to do, but it solves your cash problem for 2 or 3 years. As I say, I don't believe that our federal government has an income problem. I think it has an outgo problem.
So
And
you see the
there's
only way out of this is big cuts in spending and entitlements.
I absolutely believe that, and I also think that it has gone on so far that what we have to do is have a dishonest default. I mean, history is the guide.
Mm.
You don't remember, Maggie, because you were mercifully unborn then. But in the 1960s, we fought the war on poverty, which we lost. And we fought the war in Vietnam, which we lost. The consequence of that is we had a bunch of unpaid bills, and the highest marginal tax rate in the country was then 80%. We couldn't raise taxes. So what do? We had a dishonest default. We reduced the purchasing power of the US dollar by 75%. Now, listen, we're going to get through this, okay? We still have, and I apologize to your non-American audience, but to your American audience, we still have the most dynamic society on earth. We still have a place where 5 or 6 young kids can commandeer a garage in Sunnyvale, California. Out pops Microsoft or Google or Apple. We still have a place where for the last 60 years, our individual tenacity has funded our collective stupidity. The problem is that we've done it so long that the problem gets bigger. So we need to take a break on the stupidity part for a while. We're going to get through this, but there's going to be a reckoning. Now, they're going to fiddle around the edges, and it's going to feel like a catastrophe. An old rich guy like me, they're going to do at least 3 things to me. The first is that they're going to remove the cap on my Social Security contributions. Right now, I don't have to pay Social Security tax, which really is a 12% tax, above $160,000 in annual income. You can tell the way the burn, what a name, is running against billionaires. By the way, I'm no billionaire, that they're going to scrap the cap. The second thing they're going to do is means test Social Security, which means although they do away with the limit on what I pay, they're also going to prohibit me from getting it. In other words, it's going to be straight theft as opposed to palatable theft. They're going to raise the eligibility years, which will really piss people off. But when Social Security was enacted, it began with poverty level receipts at age 65, and the average life expectancy of an American male was 66 years.
Mm-hmm.
So it covered you at a low level for the last year of your life. Now the average life expectancy of an American male is something like 81 years, and they've lowered eligibility to 62 years. They're going to have to fix that. But it still doesn't matter. That deals with stuff on a going forward basis. The legacy liability in entitlements is $100 trillion. And the only way that you get through that is fiddling around the edges to reduce the out-year obligations while inflating away the net present value of the incumbent obligations. That's the only way you do it.
Do you think that when they devalue the dollar, it will be done in an orderly accord, global, synchronized, everyone's on the same page? Or do you see this as a disorderly event?
Well, the 70s was disorderly, and I suspect it'll be disorderly. It's ironic that, as my friend Doug Casey says, the U.S. dollar is the worst currency in the world with the sole exception of all the others.
Yeah.
When you look at the problems that face the United States and you compare them with the problems that face the European community or Canada or Japan, the U.S. problems are fairly manageable by comparison.
Well, that was my question. We're talking all about this terrible debt issue we have, but everyone has it, right? Everyone's supporting populations that are aging.
And so that's going to be disorderly. In the 1970s, what we saw was competitive devaluation. You devalue the U.S. dollar, which made U.S. dollar exports cheaper other places. And so Japan would devalue the yen too. The only medium of exchange that was simultaneously a store of value that didn't have a domestic political constituency in favor of devaluation was gold. Which is why, one of the reasons why, the price escalation in gold exceeded the price escalation that one would expect merely from the devaluation of the dollar. Really, 3 things happened. Gold had no constituency for devaluation. Every other currency did. Gold was undervalued at the beginning of the decade of the 70s because of price controls. And then our old friend momentum. By the end of the decade of the 70s, the fact that gold had moved substantiated the narrative. And when there was no longer reason for gold to move, the price doubled because morons piled on.
And you see that repeating itself.
I'm not sure about the last one. You shouldn't count on people being stupid, although it's a very common response to most stimuli.
And we see momentum is an extremely attractive proposition right now. I mean, we've got a lot of people jumping on
persuasive maybe, as opposed to attractive.
that.
It's funny you mention momentum, Maggie. I don't know if you are aware of the study that was done by Fidelity. Fidelity studied many classifications of investor: race, FICO score, sex, age, education. And they found that the most successful subclass of investors in the whole Fidelity universe was dead people. The states that didn't trade, didn't pay capital gains tax, and didn't chase the last fad. The most successful subgroup of investors in the Fidelity universe, which is millions of investors, was dead people. That tells you something about the arithmetic of fad chasing and momentum.
Yeah, it does. In a sort of terrible way for anyone who's actively managing. If the dead estates are beating,
I'm not suggesting death is an investment strategy, by the way.
Yeah, exactly. No, let's not do that. So, obviously, you this is a sort of the backdrop that you're looking at for the demand for gold to increase. Where are we with supply? Because how does that part of the equation fit in? Because this is where you really have expertise. You'll go out in terms of investing in miners and producers because you just know them down the risk profile. We had a lot of questions about why, as gold is going up, are the miners not participating in that? Because a lot of people like to do an equity expression. So what's happening on the supply side?
Well, you asked two questions there, really. With regards to the supply side of gold, it seems to increase at about 1% a year. Sort of year in, year out. There's variations. But most of the gold that's ever been mined is supply. We do a weird thing as humans. We take it out of a hole in the ground called a mine, and we put it in a hole in the ground called a vault. We use it because it's a medium of exchange that has some value as iconography and jewelry in and of itself. But most importantly, it's an asset that isn't simultaneously somebody else's liability. If you send me a check, it's my asset, it's your liability. Gold is not that. It isn't evidence of payment, it's payment itself. It has real utility as money. Now, in terms of its expressing itself in the equities, I think that one's easy. Gold has gone up not because of institution or humans like you and me buying. It's gone up because central banks buy it. And central banks don't buy gold stocks. So a market where the reason went up because there was a predominant buyer, where that predominant buyer isn't in other manifestations of the asset class, is easy to explain.
Yeah.
When, and I think it is a when, you begin to see the price action in gold justify the narrative to retail people, and as the generalist money in particular comes into the precious metal space, you will absolutely see follow through in the gold stocks. And in fact, although most people weren't in them, the higher quality gold stocks this year, the best of the best, did very well. You're beginning to see participation. So you see the Wheaton Rivers, the Agnico Eagles, even laggard performers like the Newmonts, up between 30 and 60%.
Yeah.
If past as prologue, as the momentum established by gold continues, and I believe it will, you will see more equity participation, and you will begin to see broader participation. This is because markets work. The very large cap companies that have high trading liquidities have higher share prices relative to valuation metrics, which means two things: that investors will begin to look for valuation disparities. And if those valuation disparities aren't addressed, the big companies with a lower cost of capital will take over the small companies. Mm-hmm. That's the way it's always been. Will this happen in a time frame that satisfies momentum investors? Likely not. Does that matter? Likely not. Again, this is all simple arithmetic. There are several prior markets, the granddaddy being 1970 to 80, but also 1990 to 1996 and 2000 to 2011, where we can look at the dynamics of the market, the fact that the commodity moved first, then the biggest and the best moved, then the rest of the majors moved, then the secondary producers, and then the junior producers, and then the explorers moved. Maggie, if you think about it like a circus master's whip, the front of the whip is the metal. It moves first. The tail of the whip is the juniors. It moves last, but it moves the furthest.
Yeah.
And you will see the money go through the gold market and the gold equities market, just like a circus master's whip.
That makes sense. If we see this, for all the reasons you stated about the, necessary and possibly disorderly devaluation of the dollar and other fiat driving demand for gold, would you expect to see other precious metals also benefit from that or participate, or is this a gold-only rally?
No. Precious metals bull markets in my lifetime have been led by gold. When the price action in gold justifies the precious metals narrative, to the extent that generalist investors come into space, leadership transitions to silver. Silver moves further than gold and it moves faster, but it moves later. I don't know why this is. I suspect the lower unit of value and the reputation for volatility. I think this time through, a case needs to be made for platinum and palladium too. They are not money, but they are very cheap relative to their utility. They're out of favor because the big thinkers of the world believe that the internal combustion engine is going to go away. And as a consequence of that, the need for auto catalysts is going to go away. Somebody forgot to tell the auto market that, by the way. There's political insecurity around supply in platinum. It comes from South Africa and Russia predominantly, two hardly stable places. So I believe that money could be made throughout the precious metal spectrum. I believe there's a special situations play in platinum and palladium. And I believe there's a historical play in silver. Right now, I believe the momentum is with gold. And right now, I believe probably the sweet spot in the gold equities market are the large single asset producers or the secondary producers that haven't moved. But the truth is there's lots of room left in the best of the best. I think there's money to be made, or at least money to be defended across the whole product spectrum.
That's great for a time reference. For folks, again, we were establishing retail not really participating. Maybe traditionally this hasn't been something they have exposure to in their portfolio. I'm guessing that you invest directly in the metal itself with your expertise, but are ETFs or basket of ETFs acceptable vehicle for folks who don't have as much experience in this market?
Maggie, I used to be very anti-ETF. Despite the fact that I was the largest shareholder of and employee of Sprott Inc., who sponsors gold ETFs. My opposition to ETFs is that ETFs have too many companies that I wouldn't ordinarily own with a straight face. The idea that somebody charges me a 35 or 45 basis point fee to assemble a stew where I don't like half the meat doesn't appeal to me. What I've learned, however, is that most investors have neither the time nor the inclination to construct a basket of stocks themselves. And participating in it, holding one's nose and participating in it, is probably better than not participating in it at all. Make no mistake, I personally would prefer if Maggie's subscribers owned Franco-Nevada and Wheaton Precious and Agnico Eagle, maybe now that they become more efficient, Newmont, and called it a day. That portfolio would likely underperform the gold indexes in a very good market because ironically they're too efficient. They don't get the marginal benefit from higher gold prices. but you'd probably capture 85% of the beta with half the risk, which is a good trade.
That is a damn good trade.
Most people won't allow themselves to do that. And to the extent that I'm sure most of your listeners own no gold at all, if they increase their allocation to minimally 2% of their net worth, half of it in bullion and half of it in the ETF, or optimally early in a gold bull market, 10% of their net worth, split probably equally between the bullion and a high quality ETF, not a junior ETF, I suspect the next 5 or 6 years from them will be very, very, very good. Again, take yourself back to the decade of the 70s. Let's assume that you came into the decade of the 70s with a 50-50 portfolio, half in the Dow and half in debt, half in bonds. By the end of the decade of the 70s, the prime rate of interest has gone from 4.5% to 18%. So your bonds, if they're long bonds, have lost 75% of their purchasing power. Your equity portfolio came into the decade of the 70s at the same price it exited. But remember, those are nominal prices. The purchasing powers declined by 75%. Had you had merely 10% of your portfolio in gold, the gold price was up 30-fold in the course of the decade. If you had done nothing else, the increase in price that you got from 10% of your portfolio would have offset the deterioration purchasing price that you got for 90% of your purchasing power. So I would simply suggest to people that if the mathematical case that I've made is at all persuasive, that you consider the allocation of somewhere between 2 and 10% of your portfolio to precious metals oriented assets, probably so that you don't waste a lot of time fine tuning it, half in metal and half in equities.
Do you think that we are facing the type of interest rate spike that you just described?
Unfortunately, I do. I think interest rates are a function of confidence. And I think confidence is still very high as a consequence, of living through the period 1982 to 2022, the most benign economic period in the history of mankind. Right now, the Federal Reserve controls interest rates. I lived through 2 periods of time when the Federal Reserve lost control of interest rates. One was the decade of the 70s. The second was in the Clinton administration, when he talked about the bond vigilantes. And make no mistake, artificially low interest rates are very good for people like me. They penalize savers on behalf of spenders and investors. I'm not a spender, but I am an investor. I have access to credit and I have the knowledge of how to use it. For most people, artificially low interest rates discourage savings, which is precisely what people should be doing. And if we go into a period where the arithmetic that I've described for you begins to manifest itself, particularly in investor confidence, I think you'll see a very different interest rate environment. There was a sort of a hippie slogan when I was a young man. You'd see on bumper stickers that said, "What if they gave a war and nobody came? What if they held a treasury auction and nobody came? What if people looked at the treasury yield at 4.3% and said, never mind the CPI rate of inflation, which is a lie? What if we look at the fact that the basket of goods and services that Maggie Lake acquires, gasoline, food, healthcare, health insurance, what if you realize that the deterioration of the purchasing power of your savings is closer to 7.5 or 8%? So if you buy a U.S. 10-year treasury yielding 4.3 in a currency that's depreciating by 7.5, you're losing 3% a year. You're doing it every year for 30 years. What would cause you to lose faith in the U.S. treasuries faster than the U.S. government guarantee that suggests that you would, in the course of 10 years, lose 35% of your purchasing power? If you didn't show up to buy the treasury, they would have to print. And then the whole game's off.
Yeah, and this is really, you're really speaking to the fear that some people have. And when you're describing the role of gold, this is really a diversification, right? A hedge, a diversification. And it sounds like, based on what you're saying about bonds, that this idea that 60/40, because, it was dead, but then it came back. People were talking about it being back as a way to diversify, but it sounds like you wouldn't touch bonds for
I
anything.
would I wouldn't touch long. I mean, I own a lot of 1 and 2 year paper because I have a lot of liquidity. But I wouldn't touch a long bond. I just wouldn't do it. The idea that I'm going to get paid 5 and take a bit of credit risk and take principal risk, because if the interest rate goes up, the price of that bond craters. I have zero interest in long bond. It seems to me like the worst of all possible worlds.
So what given this kind of world outlook, financial outlook, what would change? What would be something that would happen that you think would sort of throw a wrench in what you've laid out as a pretty bullish case for gold?
Global recession, depression, and a liquidity squeeze like 2008 in capital markets.
And why is that? Why is that a game changer?
Liquidity, well, it's a temporary game changer. In a liquidity squeeze, all assets fall. The sale isn't made by Maggie Lake. It's made by Maggie Lake's margin clerk. And Maggie Lake's margin.
So they sell their winners. They sell whatever they can sell.
They sell whatever has a bid.
And
I
that would be
remember in
gold.
the 1987 crash, gold held up for a day, one day, then it fell. 2008, it held up for a day, then it fell. But the fall was temporary. It came back better than lower quality asset classes. But I suggest that if we had a global recession, which allowed for a lowering of the asset values around other classes, that some other asset classes might become more attractive relative to gold. Let's say, as an example, that NVIDIA fell by 85% with its earnings capacity unchanged, that it still had the same technological advantage over its competitors and the same margins, maybe a little constrained, that it does today. Remember that Warren Buffett got through the decade of the 70s without owning gold, unscathed, because he was smart enough to buy high-quality businesses that had enough pricing power that they could keep pace with inflation. If I were as smart as Warren Buffett, I might not have to own gold either. But my experience of the decade of the 70s was that gold was a game changer, a lifesaver for me. I'm not as smart as Buffett.
Very few people have the liquidity to buy the businesses. Let's be real,
correct.
Right?
Well, in fairness, he didn't either. He bought fractional ownership in businesses by way of shares in the equity markets at that point in time. But there are very few people who have the discipline and the knowledge to confine their purchases to the Coca-Colas of the world that maintain pricing power in a period like the decade of the 70s. And for those people, I would suggest that gold is a requirement in terms of maintaining their purchasing power and lifestyle. And what's important, I hope we got this across earlier, Maggie, is that this is an insurance policy where a small premium generates a pretty good payoff. When gold moves, it really, really, really moves. If I'm right and we have a chance for a triple or quadruple of the gold price over 10 years, and gold equities that do double that, then having 10% of your portfolio likely gets you through the decade, assuming you do nothing very well with the rest of your portfolio. It likely gets you through at a break even. If I'm wrong, you have 10% of your portfolio that underperforms and the rest of your portfolio is intact.
Exactly. Exactly. Like, best case scenario, this is your problem, is that gold is underperforming, because it means everything else is great.
That would actually be a dream come true. I'm in the weird place of having a lot of my assets represented in gold, and I hope the price doesn't go up, because the set of circumstances that causes it to go up is disruptive to my lifestyle, and my lifestyle is great.
As we know, that's what we're all trying for. So, last question is about. I'll say Bitcoin. Maybe it'll be something else in a couple of years. Some digital version, some digital asset that people hope mirror gold, a digital version of gold. Some people refer to Bitcoin that now. There's a big argument. I don't want to get so in the weeds about like which is the protocol that will be that. But do you see a time over the next 5 years or so where there could be something that represents the benefits of gold, but in a digital version?
I do. It'll be digital gold.
It'll
I
be digital
believe
gold.
I believe that we'll have a deposit receipt that represents not fractional but whole ownership, and that it will be on the blockchain, and that it'll be redeemable, and they'll be able to issue tokens against it. I've invested a bit in this technology or these technologies, even though I don't know very much about the blockchain or the distributed ledger. But I believe that the distributed ledger and the potential for fractional ownership of deposit receipts restores gold to its rightful role as money, where I have a medium of exchange and simultaneously a store of value, where you can buy a service from me in fractional ownership in gold, and I can, if I want, take it to the Royal Canadian Mint or somebody like that and surrender it and receive the real thing.
So in the way that stable coins are backed by U.S. assets or presumably dollars, this would be a token that's actually backed by gold.
And redeemable for.
Right.
Importantly, and redeemable for. The London Bullion Market and the World Gold Council are working on just such a technology today. My suspicion
is it available to investors, or does it not exist publicly?
It does not exist right now. They have to work their way through the regulatory morass. Obviously, this would be a fairly attractive asset class relative to things like U.S. dollars or U.S. treasuries. You could hypothecate it and borrow against it, all those types of things. So the regulatory climate is going to be a challenge. But the truth is, in even a semi-free market, good money drives out bad. To the extent that this asset class was available to investors in, say, Liechtenstein, if it wasn't available to me in the United States, but it was redeemable in places like Great Britain and Canada, which it will be, I would buy.
Yeah,
I would invest. And that's, I think, the way of the future.
I think that you would not be alone. So interesting. Is that your sense that it might be something that it'll only take someone allowing it somewhere for it
Correct.
to get out, and then?
Correct.
Interesting.
Yeah. It will be important that the protocol allows holders of the coin to redeem for physical. It'll be important that it isn't merely a virtual asset. It'll be important that the virtual part is the medium of exchange part, but the store of value is still available to people. And the protocols that both the LBMA and the World Gold Council are working on is precisely that.
And is it a case of tokenizing existing gold in the market, or would they need future supply in order to keep up with the demand of something like that? Would that drive up actual gold prices?
I mean, you can't conjure up supply. It takes a hell of a lot of work. If the asset class became as popular as I think it might, you would probably look at central banks contribute their own gold holdings in return for digital tokens, so that they didn't have the obligations, and so that the transaction costs would come down. You know, Maggie, if you go to a reputable bullion dealer right now and you go to buy gold, you're buying gold at spot +4 or spot +4.5. If you go to sell that gold, the same thing happens to you. So the transaction costs around physical gold are fairly high. The transaction costs can disappear, virtually disappear, with the digitization of gold, because what you're trading is a deposit receipt. There would likely be a 50 basis point destocking fee, maybe a 25 basis point destocking fee, where you presented your tokens to the Royal Canadian Mint, as an example, for gold. But if you held it, those costs wouldn't exist. And to transfer it, the cost, the friction, would be similar to what they are in the Ether world or in the blockchain world.
Amazing. Is this a private company that would do that, or is this a kind of coalition of existing?
There are several private entities that are working on it right now. I suspect that it will ultimately end up probably being state sponsored. I don't know the answer to that.
Very interesting. Rick, it's always an education. And speaking of that, I know you mentioned we will put a link to your event in that's happening in July, because it's a deep dive in all of these things, and nobody better to do that than you. So we'll include a link in the description so people know where to find it and register for that.
Thank you for that. A couple things around that. First of all, unlike any other natural resource investment conference in the world, every exhibitor that you see there has been vetted. At most conferences, the vetting process is a check that cashes.
Yeah, I know. And I know that's really important to you, because we've spoken about that before.
It doesn't mean that every stock that I own goes up, but it does mean that I've invested time and treasure in them. The second thing is that unlike any other investment conference in the world, this one has a full money-back guarantee. If you come to our conference in Boca Raton, Florida, which I would prefer, or if you joined 1,000 other investors in 30 countries worldwide, viewing it on live stream, first of all, you'll have access to the tapes, the recordings, which you'll need, because we're going to give you more information in 4 days, 50 hours than you can absorb. You'll have to play the recordings again, and probably have to play the recordings a third time. Suffice it to say, if you don't believe that I have earned the tuitions I charged you, whether you attend live or live stream, simply email me. There's an absolute, no questions asked, money-back guarantee. No other investment conference that I know of on the planet has that value proposition. Every exhibitor vetted, absolute gold-plated, never mind gold-plated, solid gold, money-back guarantee.
Love it. I absolutely love it. Rick, thank you so much. This was fantastic. A lot of sort of big concepts, and some of them are pretty scary, but information is power. And so I hope everyone takes a moment to sort of think about it and check in with their portfolio to see if they feel like they are adequately addressing some of the risks we talked about. Thank you so much. I appreciate it.
Always a pleasure. Thank you for your tolerance of math.
We need it. We need it. I'm always ready to embrace it. Thanks, everybody. Hope you enjoyed. Take care and good luck out there.